Welcome back. Venezuela's state oil company is considering selling its U.S.-based unit, Citgo. Analysts say the sale of its refining and distribution network in the U.S. is the result of Venezuela's struggling economy and a dire cash shortage. Joining us with more is Martin Markovitz. He's live in Caracas with the details. Martin.
Hi, Michelle. Yes, Venezuela may now get out of the refinery business in the U.S. This possible sale comes as the cash-strapped country needs hard currency. Venezuela is currently facing a scarcity of U.S. dollars, which has fueled record inflation here. The sale of Citgo could bring much-needed revenue to the country.
Venezuela may have the cheapest gas in the world, but as the country faces deep economic issues, it's considering selling its U.S.-based refinery company, Citgo, if the price is right. Venezuela is hoping to net $10 billion and says there are interested buyers. Citgo's holdings in the U.S. are extensive. The company owns 5 refineries and has more than 6,000 gas stations across the U.S.
I think the $10 billion is a little low, given the market valuation for the 3 refinery assets in play, and even whether or not all or some of the 6,000 retail outlets are included. This should be a deal somewhere around $12.5 billion, being a more favorable valuation.
With the country fighting inflation and facing shortages of some products, Venezuela may have no choice.
One thing we should remember here is that PDVSA is in some financial difficulty back home in Venezuela precisely because the Venezuelan government over the last several years has forced PDVSA to use its profits to import foodstuffs and other products into Venezuela. PDVSA has been in the unenviable situation as an oil company that suddenly had to be financing social projects. And that has simply made the situation more acute.
Caracas is also in the middle of an international lawsuit brought by Exxon and ConocoPhillips. Citgo's sale may reduce the risk of having its assets seized.
The sale could also help Venezuela's goal of making China its principal buyer of its oil. Beijing is now Venezuela's second largest trading partner and biggest source of investment capital, totaling about $50 billion. Citgo's sale could let Caracas redirect much of these oil exports to Beijing.
Now, Martin, many are saying that it's going to be difficult for Venezuela to find a single buyer for its U.S. holdings. Why is this the case?
Yeah, some oil analysts here do say it might be hard to find a single buyer. Venezuela exports a heavier type of crude that is more difficult and more expensive to refine. 2 of Citgo's refineries in the U.S. only run heavy crude, and many oil analysts say that most companies are looking to buying cheaper, lighter crude in the lease. But, others say that Citgo has other holdings besides refinery. They own a network of infrastructure that might be of possible buyers in the future.
All right, Martin, thanks very much. Good to see you. Martin Markovitz live in Caracas.